I'm tired of working and I need a way to get my investments working harder so that I'm not just sitting here working a day job and paycheck to paycheck. My returns have beat the S&P 500 by about 6%. So my returns were 27% CAGR. KG Intelligence decided after me relentlessly emailing them that they were going to just pay out all of the cash that they make as a dividend.
Just to get rid of you. You must be pretty annoying to deal with by email, eh?
I guess so.
Bryan Shealy is one of those unassuming investors that's taking advantage of a massive glitch in the markets, and as a consequence has compounded his money at 27% over the last 5 years. In this interview, we discuss the exact opportunity he's found and 2 companies that he's particularly excited about. Actually, we'll be discussing one of those companies at the end of this episode, and we'll make the second available for anyone who's subscribed to this podcast or to our event-driven daily email list. To access that private recording, just email support@eventdrivendaily.com with a screenshot showing that you're subscribed, and we'll send you that private link. And now, Bryan Shealy. Bryan, why don't you tell us a little bit about yourself?
Let's see here. I've been investing since I was 11 years old when my dad helped me buy my first stock. I know on your previous podcast, somebody was joking about Americans getting their first stock at 11. So I just wanted to touch on that. From there, I kind of got into index stocks afterwards and just let it ride. And didn't really get serious about investing until about 7 years ago when I decided that, you know what, I'm tired of working and I need a way to get my investments working harder so that I'm not just sitting here working a day job and paycheck to paycheck. So about 7 years ago, I found the site NetNet Hunter. And from there...
I've heard of that one. I've heard of that site.
I wonder who that could be. But from there, I decided to take the leap and get a subscription and start really learning about how to invest in small cap stocks and nano cap stocks in order to get an edge. With that, I had a little mishap at the very beginning in my investing, and that was investing in some of the wrong stocks for me, I would think. One of them went to zero, which really kind of shaped how I invest. So from then on, I decided I'm only investing in stocks that make money, and I'm only investing in stocks that have dividends, and I'm only investing in stocks that basically have a path to growth. So I'm not looking for stocks that are losing money and could possibly turn around. Although I have occasionally looked at Japanese net nets that are losing money. Oh, well, it's only one stock that went to zero, and it was a shipping company that was based in Ukraine, of all things. So that one went to zero, and I decided that I would only invest in stocks that actually made money and stocks that were potentially going to be growing and had dividends. So from there, I wanted to basically find stocks that were going to grow. So even if there was a net stock that was Japanese stock and it was losing money, and I could tell that it was going to start making money, then I would watch it. And then as soon as I would see it start making money, then I would pile into it. Because the interesting about Japanese net nets is even when they go from not making money to making money, they don't jump in price like a whole lot. It's just, it takes a while for people to actually notice what's going on.
This episode is brought to you by NetNet Hunter, the best resource for NetNet stock investing on the internet. NetNets, or cigar butts, are sub-liquidation value stocks that produced such outstanding returns during Ben Graham's lifetime that he gave up all other strategies to focus on them. Professionals such as Warren Buffett and Joel Greenblatt also launched their career on the strategy, and that proved quite successful to say the least. Right now, you can get a free monthly NetNet stock pick from NetNet Hunter's free newsletter. Visit www.netnethunter.com and look for the link on the homepage. So these are companies that were maybe losing money for a couple of years, and then things turned around for them and they started making money for them. They started making money?
Yeah, exactly. They would, all of a sudden, they would restructure their business, and then from there would get rid of some bloat, and then actually start making money, and then I would just jump into it at that point.
You see this a lot in Japan too, where these companies that are, around for decades and they cycle between earnings and losses.
I would say yes and no because a lot of these companies just make money forever. Like they're always making money. They're just not making a lot of money.
Hmm.
And what it looks like to investors from the outside is that they're not actually making a lot of money, but in fact, they kind of are making a decent amount of money, but they have so much bloat in their company, in their stock, and their equity, basically, that it looks like that they're not making a ton of money. But when you actually look and see that they have a bunch of like equities in other companies, um, and you strip that away, they're actually doing pretty good on ROE.
So I guess with all that said, the viewers should probably have a pretty good idea of what we're going to talk about today. But why don't you go ahead and tell us about the opportunity that you see today?
So basically, about I think 3 years ago, I decided to completely sell out of pretty much every other stock that I had and invest only in Japanese equities. And that was when the Japanese TSX exchange, decided to release some information that were trying to get the companies that are in the exchange to increase their book value, increase their return on equity, and basically their efficiencies. From that moment, I was like, you know what? This is some easy investing for the next 8 years. So I'm just going to go ahead and stick with this and ride this until 2030, basically. And
Interesting.
if you look at my returns over the past 5 years, after I got over that hump of failing miserably, my returns have beat the S&P 500 by about 6%. So my returns were 20% or 27% CAGR, whereas the S&P was 21% over the same time. Which, I mean, 21% for the S&P is pretty darn good. But then getting 27% over those 5 years surprised me even more.
Yeah, that's outstanding. You mentioned that the companies or the TSE, I guess it is Tokyo Stock Exchange, was trying to get these companies to boost book value. Did you mean price to book value? So get that ratio up?
Yeah, they want to get their price to book value up because many of these companies are trading below book value, and even and not just book value, but net current assets.
So why would the TSE want to do this? Well, first of all, is it just the TSE? And then why would the TSE want to do this?
Yeah, it's just the TSE because there's another exchange in Japan that's in another city. I forget, but Outsiders basically,
Nagasaki, I think it is.
yeah, Nagoya Stock Exchange.
Nagoya. Okay, okay.
Yeah, that one is only for Japanese people. Only Japanese people can invest in it. The TSE is international, so international investors can invest in it. So the idea is for the more international investors to invest in the TSE, and they're trying to attract more international investors. So it's a three-pronged approach. They're trying to get the return on equity up, they're trying to get the book values up, and they're trying to get the governance guidelines up. So basically, they need to have independent directors, otherwise they're going to be kicked off the exchanges. So that's kind of trying to entice more international investors to get into the space, therefore rising stock prices as well. Um, Another thing that's actually helping this too is they created a new retirement account for Japanese investors that they can utilize to invest in these stocks as well. So, I mean, everything is firing on all cylinders to get these Japanese stock prices up, which is one of the reasons why I say if you're not investing in Japan at all, then you're missing out on probably one of the biggest opportunities in investing.
But why would the TSE want to do this? I mean, I understand that they want to get the valuations up and they're looking maybe to attract American investors or international investors. But why would that be important to them?
Well, I mean, there's two reasons. One of them being is they are a company and they make money by getting stocks listed on their exchange. They also make money every time they need to like issue more shares. And so, and with that, they want to increase the amount of money that they are getting from there. I mean, the other kind of thing is it's a pride thing for Japan, is they want to get the stock prices up so that it's better. It looks better for Japan. They also want to get the economy kind of like moving more steadily again. So I would say that the first one, company first, is important, but then also the bigger thing is the government is pushing for this to happen as well, because they want Japan to turn around and get away from deflation and get away from basically having a bad environment for companies to grow and help the entire society.
So that makes sense. What is the TSE doing to kind of facilitate this?
So they released their document stating exactly what companies need to do. What they're doing is they're kind of creating shame, which is a big thing in Japan, which companies are getting shamed by the exchange because the TSE is creating basically a list of companies that have already announced their plans and what they're going to do to get their ROEs up, to get their book values up. And it basically, if you're listed on that, then it's a source of pride. And if you're not listed on that, then it kind of makes you want to get your butt in gear to get on that list so that you can, not be the odd one out.
Okay. So it's kind of like a peer pressure kind of tactic that they're using.
Yeah, and it's really big in Japan, peer pressure, especially with such a conforming society.
Right.
It's more of a big deal there than it is here in the United States.
Right. I imagine, if you're an American investor, Canadian investor, or just basically an investor in the West, you might be looking at this and thinking, well, if I ran a company, I wouldn't really care what other companies are doing. I would just kind of do my thing and be happy with it, especially if I'm a CEO and I'm making, a good amount of money. But the culture there is totally different. So this might have a pretty big impact that it wouldn't have in the US or in the West generally.
And one thing I forgot to mention is they will be kicking people off of their exchange if they do not meet these goals. I think their cutoff is by 2030.
Oh, interesting. Oh, okay. So that kind of explains your 2030 timeline then.
Yeah, and when I see a lot of the midterm management plans, that is their goal, to get ROE 8% or above before 2030,
Okay,
or at least by 2030.
interesting. So obviously they have that big list of companies that have announced their plans on how to get their valuations up. But what exactly do you personally look for in a company that is going to maybe rebound in price or grow in price?
I basically look for in that they have that management plan, um, that they're trading below book value by 50% or more, and that they have a dividend, which pretty much all of them do. Uh, and from there, when I look at that management plan to get the share price up, I look kind of how they're going to do it, and if they're not stating that they're going to buy back shares or they're going to raise the dividend, then I kind of like pass on it, because I'm like,
Hmm.
okay, so they're just going to grow the company, and like that's risky. Like, what else are they going to do? So I like it when they say they're going to grow the company and do those other things,
Right.
because then it basically is a multi-pronged approach to get that share price up.
Now, obviously the Japanese speak Japanese, they don't speak English, and they publish pretty much all their reports in Japanese. I mean, you can look at these larger companies, and those are published somewhat in English, but primarily it's a Japanese market publishing in Japanese. So, how do you get around that?
So what I utilize is Google Doc, or the Google Translate for documents. So from there, I'll download their reports on their website, and I'll upload it to that, and it'll translate it for me. And from there, I'll be able to kind of read what their plans are, what their management plans are, pretty much their financials, and that's how I get around that. If I want to reach out to the company, then I actually use ChatGPT in order to kind of translate to Japanese what I want to say to them. So I'll write in English. I'll have ChatGPT kind of smooth it out. Then I'll have it translated to Japanese. And I've actually utilized that a couple of times to engage in shareholder activism, to tell them this is what the Japanese stock market wants you to do. This is what you guys need to do. I'm just an investor in your company, and I want to know what your plans are and when you're going to like start doing this in order to get your share price up. I would say that I've had some success and some not so successful problems with that, because one of the companies I got a little aggressive with because they would not give me like a good answer. So they told me to basically like screw off.
Yeah, but in a very Japanese way, so it was super polite, I bet.
I mean, polite, but as polite as you could be, I guess, while being also upset with me, I guess.
So interesting. Does this tend to add value to your portfolio, or is it just better to invest in companies that have already announced share buybacks?
I actually don't know if it adds value. I feel like if I'm bored and I want to do it, then it adds value to me. There's been a couple of companies after I've done it that have actually, you know, done something and their share price has moved up substantially.
Hmm.
One of those companies being KG Intelligence,
Okay.
which decided after me relentlessly emailing them that they were going to just pay out all of the cash that they make as a dividend.
Just to get rid of you, you must be pretty annoying to deal with by email, eh?
I guess so. Which is kind of like upsetting that I try to get in contact with so many of these companies, and half the time I can't, because either they don't have an email, or the way to reach them via email, you have to put like some kind of surname, and then it doesn't work, and then they don't respond to you. So I've even thought about paying some people in Japan to get in contact with these companies and get me in contact so that I can actually email them directly, which would pretty much be my next step if I actually have enough money in one company that I want to push them. But right now, it's kind of so easy that I don't need to push that much. But I
Right.
eventually will, probably towards 2030, when it's nearing the end and there's probably less companies around.
And there's been a renaissance of activists in Japan as well. I know that, just in the last 5 years or so, a number of activist companies have moved into Japan looking to take advantage of the situation. And it also seems that the TSE is a little bit more welcoming, I would say, of Japanese activists.
Yeah, they actually have on their website a hotline basically where you can reach out to them and say this company is not acting in shareholders' interest, and basically open kind of like a quasi lawsuit against that company. So that's one of the things that a lot of the international investors are going towards in order to get these companies to start acting like they're it's not their company, it's the shareholders and other stakeholders' company.
Have you thought about maybe publishing articles in various Japanese websites in Japanese, highlighting the fact that the company is kind of not shareholder friendly or they're not making smart capital allocation decisions?
I actually have not thought about doing that, mainly because, I mean, who's going to read it? And I don't write in Japanese, so I would basically just be trusting ChatGPT extensively
Right.
in that situation where uh, it's saying what I want it to say.
I guess it depends how big the publication is, right? Because if you're publishing in pretty large Japanese websites and you have, say, a Japanese set of eyes, somebody from Japan to look at this and kind of okay it, then that might be more effective.
Yeah, and I don't think management would take too kindly to it. they might get super aggressive and start, you know, taking measures like poison pill,
Mm.
which they have done at a company that I currently own
Mm-hmm.
and are getting a substantial payout from it. So, um, in that situation, I'm kind of like, I
Right.
don't want to go that way. I just want to basically nudge management.
This episode is brought to you by Event Driven Daily. If you're spending too much time trying to uncover special situation stocks, make sure to look at Event Driven Daily's Morning Brew newsletter. Each month, we scour the internet to find as many special situation opportunities as possible, and then send each and every special situation to free subscribers in a neatly packaged email. This service is absolutely free and will save you hours each month trying to source special situation ideas. Go to www.eventdrivendaily.com and look for the subscribe button at the top of the page. That's www.eventdrivendaily.com. I've invested in Japan in the past, and it's worked out really well for some of them. And then obviously it's worked out not so well for others. But one thing that I really like to look for in my cigar butts are companies that are growing and possibly going to grow going forward. But I always find it really tough to tell whether a Japanese company that I picked out has continued growth ahead. How do you look into that?
Whether they have continued growth.
Yeah, whether
Uh,
they're, likely to grow into the future, like say 5 years out, 10 years out.
well, that's the thing. I mean, you can't see the future. You don't know whether they're going to grow or not. You just have to take their word for it that they're going in their management plan. They say that they're going to invest, they're going to grow their revenues, and they're going to make more money. So, what I typically do is I'll look for, you know, ways in which they're actually growing. So, kind of a track record of their earnings growth. So, if I see that their earnings growth over 5 years is trending upwards, then it's a pretty good idea that they actually know what they're doing and they know how to grow their company. Um, I mean, as far as I'm concerned with a lot of these companies right now, I don't care particularly about a lot of growth. I care about, are they growing? Because they're supposed to get their book value to one, okay, over the next 5 years. If the company is trading 50% below book value, if you get to one, that's 20% per year.
Hmm.
If there's a growth rate anywhere above 1%, I mean, that's just icing on the cake.
Right,
So
definitely.
I'm not particularly concerned about growth, although it is nice to have. And I do look for companies that are already growing at a certain rate. So, for example, there's a company that I currently own. I don't know if you want me to get into this now.
Well, actually, this is a good chance to jump off into the companies that you want to talk about. I know that you have two that you're thinking about. The first one, I think we can cover on this video. And the second one, I think we're going to reserve it for subscribers. So anybody who's subscribed to our YouTube channel or our podcast, just a free subscriber, or our email newsletter at eventdrivendaily.com. If you email us at support@eventdrivendaily.com with a screenshot showing that you're subscribed, then we'll send you the link to the private video for the second one. But why don't you go ahead right now and walk us through the first company you like?
All right, so this one's a really, really good one in terms of growth because you're very interested about how these companies are growing. So I don't know. Do any of you like anime watching? I know I'm a
We've
pretty big.
had one previous guest on who is big into anime. So,
Well, this company is basically an anime play. So it's called Art Vivant, and it's a company that basically most of their money that they get is from selling prints for anime, and I think they've had a lot of different licenses that they use. It also is a hot yoga and a banking company. So those are some interesting side things that you get from owning the company. But first and foremost, it's an anime print company. So you can
So
get,
this is a pretty interesting quirk with Japan, because in Japan, in the West, we have companies that are pretty focused on one area or one niche or something like that. But in Japan, they're all conglomerates, right? And so you get some pretty interesting mixes. So this one is, you said, anime and hot yoga and banking. So interesting.
yeah.
Sorry to cut you off, but yeah, continue.
Yeah, so it's interesting in that aspect. I know the hot yoga part doesn't bring in a whole lot of revenue. Their banking is really just kind of more like an investment arm where they help to invest in different companies in order to kind of help them grow, and then they kind of get a slice of it. A little private equity, I think,
Hmm.
in the way they operate it. And then the anime part, which is its big part, it makes the most money. I think it's probably like 80% of the company, but correct me if I'm wrong there. I haven't looked at that percentage in a while. I just know that it's a large percentage of the company. So one of the things I did look into was how much anime is projected to grow over the next 10 years. And pretty much some of the results that I saw coming back were about 12%. So, I mean, 12% growth per year on this company. Um, I'm seeing probably maybe 10% if it's not capturing all of that percentage that the company has. So, say it's like 80%, and then there's 12% growth in the space. It's not going to get that 12%, but it'll probably get pretty close to it. So, in that terms, I know I'm going to be beating the market if I'm investing in this company because of the growth trend of the industry.
Mm-hmm.
And an interesting thing with this company is it is still trading below book value. It's at about net current asset value right now. But for over the past year, they've been giving a special dividend. So the dividend percentage that I've been getting on this company over the past year has been 10%.
Wow, that's great.
So I'm getting 10% on this company. And then I kind of got excited when I looked. They also are the company that is buying back the most shares out of all the companies that I own.
Interesting.
And that kind of took me aback too, because I don't remember them stating that they were going to do that. So I had a kind of a double take. But they're buying back their yield for buyback is 12.7% right now.
Wow.
So not only you're getting a 10% dividend, but you're getting a 12.7% buyback.
Wow. So 22, 23% shareholder yield.
Yeah, which is pretty astronomical.
Right.
So when I saw that, I decided to invest more. I was thinking about selling the company, but because I mean, this company is so shareholder friendly, I just bought more shares in it because, I mean, there's still 40%, actually, no, 80% more until it gets to book value. So,
So
why
it's
not?
trading for roughly a price to book of 55%, I guess, or
It's
0.55, however you want to write it.
So this price to book value of it is zero point 0.6. Price to
Point 0.6.
tangible
Okay.
book value.
Right.
Net current asset value is actually 93%, so it's pretty close to 100.
Okay.
But
Interesting.
yeah, that's one of the things I kind of want to bring up too is for net current asset value, I like to buy companies that are below net current asset value. But for these Japanese stocks, I'm probably not going to sell them until they reach book value.
So what is the market cap on this from in US dollars, just to kind of put everything on an even keel here?
Oh, in US dollars? Let's
Right.
see. To change my currency.
This is happening live, folks.
So the market cap of this company in US dollars is 65 million.
Yeah, and so the smaller you get on these net current asset value stocks, generally speaking, the better they do as a group.
Uh, so I would say so, but what I've been doing recently is I have yeah, I'll let you guys in on a secret here. I buy too many stocks. So I currently have 25 stocks in my portfolio that are all Japanese stocks. And the problem is as soon as I start researching, I find something I like. I will always find something I like. So I'll end up buying that stock, but I'll always buy just a little bit, and then I'll keep kind of telling myself, I need to kind of like pare down the amount of stocks I have. So I'll keep putting more and more money in stocks that I like the most.
Right.
So even though I have a large number of stocks, I am heavily weighted on like about 8 to 10 of them. So I would say
Okay.
like 70% of my money is in like 8 of those stocks.
And as they rise in price, they just become a bigger percentage of your portfolio anyway. So your winners end up taking up a bigger share, a bigger chunk of your money.
Yeah, and then I sell them and then put it in the lowest, the 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 stock that I have the least money in, and I think has the most potential.
Now, I invested in Art Vivant a long time ago. It was a low PE net that was growing, so it worked out quite well for me. Now, in terms of the price to earnings, do you look at that with this company, or what's that measured at right now?
I mean, I like to look at price to earnings, but it's just kind of like icing on the cake. I honestly don't really care for price to earnings. I think my most favorite ratios to look at are earnings growth, return on equity, and return on invested capital.
Hmm.
Especially looking between return on invested capital and return on equity, because I like to see kind of how the company is utilizing the money and pretty much how bloated the company is.
Is it loaded with debt? Is a weak current ratio? What's the balance sheet like?
So actually, this company does have one of the higher debts in Japanese companies, but that's one of the reasons why its return on equity is so much higher than all those companies. It has a 55% total debt to equity on it, which I mean is a little bit too much for me, but at the same time, they're the way that they're operating, they're making money. I don't see it as a problem unless they're like really inching it up there towards like 80%. But they pretty much haven't gone over, I think 65% over the time that I've seen.
Solid current ratio?
Current ratio?
Yeah.
I actually don't think I've been looking at that ratio as much. Current ratio to me, I'm not really that concerned about it.
Hmm.
I know that I look at balance sheet and I'll see if the company has a lot of receivables. I won't like it just because to me, I've gotten in a situation with a lot of companies where they'll just write off those receivables and then the company value just drops. So when I'm looking at these companies, I'm mostly looking for cash and pretty much investments that they're selling off.
So, how would you personally go about finding more companies that are prime targets for revaluation?
So typically, what I'll do is I'll utilize two resources. One of them being Net Hunter, so I can go there and find companies that are trading below net current asset value. Another thing I do is I find screeners. One of them being Finbox.
Hmm.
So Finbox is a screener that I've used to I can actually sort between a lot of different ratios that I'm looking for. A lot of them being below book value, trading below net current asset value, even. So I can find those kinds of companies as well as companies that are buying back shares and basically a lot of different metrics that you can find on Finbox.
Interesting. Okay. So, if people want to kind of keep up with your work and want to know what you're doing, what's the best way to follow you?
So I guess there's a couple ways. If you want to talk to me directly, one of the ways is to get a subscription to NetNet Hunter, and then I'm on the forums there. Another one is I'm an author on Seeking Alpha. I used to write about American companies before I went full Japanese stock investing. So it's a little bit difficult to write about Japanese companies there. But if you want to look at some of the Japanese companies that I've invested in, then you can look at exploitinvesting.com. From there, you can see kind of write-ups on a couple of companies that I've invested in. One of the big things, if you're kind of a little bit wary about investing or interested in my track record, is I did write about my portfolio for 2 years and how it performed. I haven't kept up with it over the last year or so just because I've had a new kid and it's been really hard to get into writing again. So I mean, if there's a lot of interest in that, then I can go ahead and keep writing more if a lot of people are interested. But yeah, you can either reach me through Seeking Alpha or my email address on exploitinvesting.com.
Awesome. Thanks for talking to us.